Welcome to this explainer on the dual screen method, fundamental what and technical when. There is a deadly trap out there that literally kills more beginner accounts than almost anything else, and it's this: buying a genuinely excellent company at exactly the wrong moment. Why does it happen? Well, it's usually because you only checked one half of the investment picture. You looked at how good the business is, but you never actually checked whether the trend says it's safe to buy right now.
Let's think back to March of 2000. Cisco Systems was literally the most valuable company on Earth. As we saw in episode 1.1a, they were pulling in record revenue, record profits, and they had the absolute best product in their category, the whole shebang. Yet, just 18 months later, that exact same perfect company had lost 86% of its value. Now, the company didn't suddenly get worse. The macroeconomic ocean did, and every boat on it, even the strongest ones, went down with the tide.
So, let's really dive into this, because this exact scenario is what we call the fundamental trap. It happens when investors buy a fundamentally sound, genuinely excellent company, but they buy it right in the middle of a crashing market. They completely ignore the broader market tide, just assuming the company's strong balance sheet is going to act as some kind of life raft. But as we just saw with Cisco, a great company purchased at the exact wrong moment is still a losing trade, every single time.
So, how do we fix this? The solution to avoiding this trap entirely is what we call the dual screening method. I want you to think of this method like looking through two completely distinct lenses before you ever make a move. The first lens, fundamental screening, well, that gives you the what to buy. The second lens, technical screening, gives you the when to actually buy it.
The absolutely crucial takeaway here is that this is a mandatory two-part analysis. You need both of these answers before you risk a single dollar of your own money. Using one screen without the other, it's basically flying partially blind, no matter how confident you might feel about the setup. Think of it like a referee who needs both flags raised before the play actually counts. Section 1. Lens 1. The fundamental what.
This first lens is where we figure out what to buy by looking strictly at the business itself. Fundamental screening focuses heavily on the underlying financial health and the intrinsic value of the company. We're looking for hard, concrete, quantitative measures here. Things like earnings per share, or EPS, growth. We want to see really strong sales growth, and we absolutely need to check their debt ratios to make sure the company hasn't borrowed so much cash that they'll get crushed if credit tightens up. Basically, these metrics tell us if the underlying business is actually healthy and growing.
Moving on to Section 2, Lens 2, the technical when.
Here's the thing. A healthy business just isn't enough on its own. We have to know if it's actually safe to pull the trigger, right? And that is exactly where technical screening comes into play. This screen completely ignores what the company actually sells. Instead, it focuses purely on price action, volume, and moving averages. Specifically, looking at the 50-day and 200-day moving average lines. These specific metrics cut through the noise and clarify the true direction of the current trend. They reflect the actual psychology of the market, telling us point blank whether institutional money is accumulating or distributing that stock. Okay, so let's break down the actual mechanical rules for this. For any stock to pass the technical screen, we need to see a green light that confirms an established uptrend. Step 1. The stock's price must be trading above its 50-day moving average. Step 2. That 50-day moving average has to be sitting above the 200-day moving average. And Step 3. Both of these moving average lines must be rising.
Now, I really cannot emphasize this enough. If that technical trend condition fails, the stock is a no trade. Period. Full stop. It literally does not matter how incredible the fundamentals look. If the 50-day is below the 200-day, or if the price is just trapped underneath a downward-sloping moving average, the market is screaming something at you about timing that the balance sheet just cannot see yet.
Let's do a quick check just to make sure this is totally locked in. Imagine you find a stock where earnings per share is growing by a massive 20% year over year. Sales are off the charts great. But you look at the price action and the stock is trading below both its 50 and 200-day moving averages. Based on everything we just talked about with the dual screen method, does this trade pass?
The answer is a hard no. Strong EPS paired with a failing trend means the technical screen fails entirely. That tempting, amazing earnings story simply cannot override a failing technical trend. The broader tide is working against the stock right now, and you absolutely must wait for trend confirmation before entering.
And this brings up a really vital warning from our source material. Quote, cheap is not the same as safe, especially in a bear market. A stock hitting a 52-week low might look fundamentally cheap on paper, but in a downward trend, a so-called cheap stock can easily fall straight to zero if the underlying business is getting caught in a receding macroeconomic tide. Value investing can be incredibly dangerous in a bear market if you just completely ignore the technicals.
So the absolutely crucial point to take away from this explainer today is this core equation right here. Fundamental analysis equals what to buy. Technical analysis equals when it's safe to buy it. You've got to run every single stock idea through both of these distinct screens before you even consider an entry. Don't be that sailor obsessing over polishing the deck of the boat while completely ignoring the hurricane forecast. Up next, Part 2, Patterns and the Trap in Action. You now know the dual screen method, the specific fundamental metrics to check, and the exact moving average conditions that confirm a technical uptrend. But once that green light finally flashes, what exact chart shape tells you the precise second to pull the trigger? In our next explainer, we're going to uncover the specific patterns, like the cup with handle and head and shoulders, that time your exact entry, and we'll even look at a real-world example of the fundamental trap playing out in 2022. Until then, I want to leave you with this question to think about. How many stocks in your current portfolio would actually survive the dual screen test today?